Your employer can promise you unlimited paid vacation, fire you the next day, and owe you exactly $0 for every single day you never took off. That is not a glitch they failed to fix. In most of the United States, that is the entire structure of the policy. Under traditional paid time off, every hour you work earns a fractional entitlement to paid leave. The California Supreme Court established this in 1982 in Suastes versus Plastic Dress-Up Company. Vacation pay is not a gift. It is deferred compensation, wages you earn incrementally as you render service, which vest immediately. California Labor Code Section 227.3 prohibits use it or lose it policies. Your employer must pay out every accrued hour at your final rate of pay when you leave. Unlimited PTO eliminates the accrual entirely. No fixed baseline of leave hours per pay period. No discrete quantum of time that accumulates. No deferred wages that vest as labor is performed. The accounting balance stands at zero. When separation occurs, the statutory obligation to issue a cash payout disappears. The financial incentive is direct. Under standard accounting guidelines, employers must carry traditional accrued vacation time as a current liability on the balance sheet. For large enterprises employing thousands of workers in mandatory payout states like California or Colorado, these liabilities routinely total tens of millions of dollars. Replacing fixed accrual systems with a non-accrual structure eliminates those wage liabilities entirely. Balance sheets become leaner. Workforce reductions no longer trigger immediate cash obligations for earned leave. The legal enforceability of this structure landed before the California Court of Appeal in 2020 in McPherson versus EF Intercultural Foundation. The employer maintained an unwritten, informal paid time off practice for exempt salaried area managers, meaning employees classified as exempt from overtime requirements under wage and hour laws. Non-exempt personnel, those entitled to overtime pay, accrued fixed vacation time under a written handbook. Supervisors told area managers verbally that they could take time off as needed outside peak seasons, provided they gave notice. The company did not track leave usage and refused payout upon separation, claiming the policy was non-accruing and unlimited. 3 former area managers filed suit, alleging the informal policy was a disguised accrual plan subject to California Labor Code Section 227.3. The Court of Appeal affirmed the judgment for the employees. The policy imposed limits that never appeared in writing. Work schedules, seasonal demands, and management expectations created an implied cap on utilization, restricting actual time taken to a standard corporate range of 2 to 6 weeks. The employer failed to convey the non-accrual nature of the policy in a clear written agreement. And the evidence showed that the plaintiffs took less time off than corporate employees covered by the traditional accrued vacation policy. Allowing an employer to avoid wage payouts through an unwritten, operationally restricted, unlimited policy would permit a de facto use it or lose it forfeiture scheme in violation of state law. But the McPherson court clarified that non-accrual unlimited PTO plans are not inherently unlawful. The opinion established how employers can structure legally compliant non-accrual policies that remain exempt from statutory payout mandates. Here is what separates a genuine non-accrual plan from a disguised accrual policy that courts will reclassify and force your employer to pay out. It has to be in writing, not a verbal promise from your manager, not an email thread, a detailed, unambiguous written agreement distributed to every covered worker, explicitly stating that time off does not accrue incrementally and that paid leave is a flexible work schedule commitment, not deferred compensation. It cannot operate with hidden caps. If your employer enforces a cap on consecutive days off or maintains management expectations aligned with traditional accrual tiers, courts will treat the policy as an accrual system with an implied cap. Employees must have a genuine opportunity to take the time off. If heavy workloads,
Lean staffing or aggressive performance metrics make taking leave practically impossible, the policy fails judicial review. A policy that exists on paper but cannot be used in practice functions as an unlawful forfeiture scheme. And if people who actually take time off get worse reviews than people who don't, that's not a real policy.
Courts check leave records to make sure using your time off doesn't cost you promotions or pay raises. Finally, the written policy must outline the specific rights and obligations of both the employee and manager regarding approval workflows, advance notice requirements, and the operational rules for requesting unscheduled time off. The numbers reveal something counterintuitive.
A 2018 study by HR software provider Namely found that workers under unlimited PTO took an average of 13 days off annually, compared to 15 days taken by employees under traditional fixed allotment plans. The absence of an explicit leave baseline created choice ambiguity. Employees defaulted to taking less time off to avoid appearing uncommitted. Peer pressure in competitive corporate environments amplified the effect. And because unlimited PTO requires individual supervisory approval, leave requests were subject to variable manager standards and team workload pressures. Then the numbers shifted. A 2024 SHRM study revealed that employees under unlimited PTO structures took an average of 16 days off annually, compared to 14 days among workers under traditional accrual plans. But broader research from World at Work and the Harris Poll indicates that 51 to 78% of U.S. workers fail to use their full allotment of paid leave, regardless of policy structure. The freedom paradox persists. Eliminating fixed vacation buckets removes an explicit legal entitlement. In organizations without clear usage guidelines, employees frequently experience ambiguity regarding acceptable norms. But the part almost nobody knows is still coming. Employers adopted unlimited PTO to simplify their balance sheets. They ended up with 50 different state compliance manuals instead. California only lets you use unlimited PTO for sick leave if you front-load the whole year's worth up front and spell it out on the pay stub. New York does the same, except unused sick time still has to carry over, which unlimited plans aren't built to track. Minnesota just says, if your PTO bank covers sick leave, the whole bank now has to follow sick leave law. 3 states, 3 different requirements, 0 consistency. State wage payment obligations depend on the physical location of the worker rather than the employer's corporate headquarters. A multi-state employer operating an unlimited PTO policy must adapt handbook terms to comply with mandatory payout and sick leave rules across every jurisdiction where remote employees reside. The policy that looks simple on paper becomes a compliance labyrinth in practice. And here is where it gets personal. If you are evaluating an offer with unlimited PTO, consider reviewing several structural elements before you sign. Request the formal employee handbook language governing time off. Confirm whether the policy explicitly defines PTO as a flexible work arrangement rather than accrued wages. Verify that the terms comply with the written disclosure requirements established in McPherson. Determine whether the policy incorporates mandatory minimum leave requirements. Written minimum usage terms reduce ambiguity and demonstrate an organizational culture supporting time off. Review the procedural mechanics required to take leave. Check for extensive operational blackout windows, advance notice rules, or manager approval friction. Ask specific questions during interviews. What was the average number of PTO days taken by team members in this department over the past calendar year? How are team coverage and project deadlines managed when an employee takes extended leave? Does the organization track leave utilization to ensure equitable time off distribution across the team? McPherson remains the leading precedent in this area. Non-accrual unlimited PTO plans can be legally compliant, but the label alone protects nothing. An unwritten policy, an implied cap, or a workplace culture that punishes time off
may convert the plan into a traditional accrual system, subject to mandatory payout upon separation. The court will look at what actually happened, not what the handbook claimed. The real lesson here is not that unlimited PTO is inherently deceptive. It is that the policy removes a financial safety net you may not realize you had. Under a traditional plan, your unused vacation is a stored wage. It belongs to you. Under a non-accrual plan, that stored wage does not exist. If you are laid off, you receive zero vacation payout. The economic value of your unused time off may evaporate. Many candidates find it helpful to treat the policy as a contract term worth reviewing closely, not merely a perk worth celebrating. Ask the hard questions before you sign, because once you are inside the system, the ambiguity works in one direction only. Tomorrow, we're looking at the obscure federal law that lets the government take your gold in a national emergency. It is still active, and the trigger condition is narrower than you think, which makes it more dangerous, not less. You will want to see that one. Subscribe if you have not already.